Thank you very much, Heather. So our two presenters today are two of Farm Credit East's most experienced business consultants. We have Erin Pirro, who is based in our Enfield, Connecticut office. Erin has been helping farmers large and small make their businesses run better since 2001. She is a certified agricultural consultant with a background in agricultural economics. Her focus is on benchmarking and profitability improvement because, as she puts it, sustainability means economic sustainability too. Her work is centered on successfully coaching ag businesses, especially ag retail businesses, to analyze their companies from many angles in order to pinpoint methods to improve their management and profitability. Next, we have Keith Dickinson. Keith Dickinson is a business consultant based out of our Bridgeton, New Jersey branch office. His territory includes all of New Jersey and the lower Hudson Valley region of New York, and he works in other areas as needed to serve client needs. Keith works with farmers and other ag business owners to assist them in the planning and management of their businesses, and specific areas of focus for him include business planning, profitability analysis, estate and farm succession planning, and business entity succession and management. So both Keith and Erin have been around for quite some time with Farm Credit East, have a tremendous amount of experience and knowledge, and their experience is particularly in-depth in the Paycheck Protection Program, which is what we'll be talking about today. If we could have the next slide, please. Thank you. Just a disclaimer here that the information that we're presenting is general, and the information to your specific circumstances may vary somewhat. We could have the next slide, please. I also wanted to mention our resource hub, farmcrediteast.com. If you go to the main page, there is a COVID-19 resource hub that has information on everything related to the COVID-19 situation. It has information on federal relief programs, other knowledge exchange articles, and a wealth of information there. So I encourage you to check that out. There is also some FAQs that will be posted along with the recording of this webinar. On the farmcrediteast.com website, there is also a page for webinars. And as Heather mentioned, this recording will be posted there as well. So without further ado, I will turn it over to Keith, who will begin the presentation.
I think, Erin, you're up first.
Oh, sorry, I apologize, Erin.
Good morning, everyone. If you're just joining us, you've probably at least heard in the news the flurry of activities since the end of March, when Congress passed and the President signed into law the CARES Act, which included money for the Paycheck Protection Program. The goal of this program was to keep employees paid during the COVID-19 shutdown and to replace unemployment, because there was no easy way, with all the burden of the paperwork at the unemployment office, that they were going to be able to handle the volume of claims. So they figured if they could get money to the hands of small business owners, they could continue writing checks to people, whether or not they were still working, so that we could keep our country employed. If small businesses were interested, they could apply for the Paycheck Protection Program loan to cover eligible payroll costs. And there was a provision that they could use that money also for interest, rent, or utility expenses. So if the loan was approved by the Small Business Administration and you received the funds and you spend the right amount on the right things in the right time period, you can apply to have them forgiven, or partially forgiven, as we now know. Now, this information was released last Friday by the Small Business Administration. We've heard a lot of different chatter in the news, in Congress, on Twitter, wherever you like to get your information about what may happen. What we're presenting today is what we know right now and what the rules are as of right now. So stay tuned, things may change, but they have not yet. So what we're presenting today is what SBA has delivered so far.
So the big picture from the perspective here at Farm Credit East. How does forgiveness go? Borrowers, you will compile that documentation to support your application. You will complete your application for forgiveness after that covered period is complete. You're going to hear the word covered period. I think we define it in a slide or two here, but that's essentially the 8 weeks that started the day that the money was deposited into your bank account, or will be deposited, because I know there are still a few folks that have not yet received their funding but are in process. You'll need to submit the package to the lender. It doesn't go straight to SBA. It goes to the lender who you borrowed the money from. And then that lender submits the package to SBA for approval for forgiveness, and that's how the process will flow. Some resources that we are doing and have planned for this webinar that you're on today. We will repeat this webinar tomorrow. It'll be the exact same content. And then that's today and tomorrow. They're May 21st and 22nd. But we know that there's going to be questions that continue to roll in as this process goes forward. So we're trying to make sure that we're keeping you as updated as possible. As Erin said, we do anticipate that there could be changes to some of these aspects of forgiveness. So we're scheduling office hours. We're going to start next Wednesday on May 27th. You may have already gotten an invitation to that. And we'll keep doing those periodically, perhaps even weekly, in order to give you an opportunity just to log in and ask questions that you may have on this forgiveness process and the PPP loan process. And certainly as new information, if new information comes out from the SBA or Department of Treasury, we'll update you through that medium. And there, that last bullet on the page there, when we get towards the end of June, early July, we're planning to do another more detailed webinar that really gets into the nitty gritty and down into and deeper into the weeds, so to speak, of actually completing the application for forgiveness. You know, as we've noted here, the application doesn't get completed until after your 8-week period is done, just based on a timeline of when the earliest folks got their loans. The earliest they'll be able to complete an application would be, you know, the second or third week of June. So we're looking at that June, July timeframe as when we would get into that detail.
This, as I said before, is just the first pass. It's what we know now. So it is going to be the borrower's responsibility to complete the form to the lender. And lenders may have different processes, just keep in mind. So what we're going to go through today is the general information that you are going to need, and you will have to compile that in whatever form is asked of you later on. So just stay tuned, and we'll, as Keith said, deliver some resources to help you get through that. The important thing to remember is that forgiveness is not automatic. So you are going to have to do some paperwork in order to apply for that. But considering it's a loan that's forgiven, that's a pretty big deal and worth the time and effort, I think. If you'd like a head start, you can download the forgiveness application from SBA.gov, or the link is available from our COVID-19 resource hub on farmcrediteast.com. And again, we do expect more guidance from SBA. There are a few questions we have in reading through the information. We expect you will have some more too. So we'll need to stay tuned. It took a little while for them to catch up on some of the ag rules in the first round, but they did. So let's just be patient and keep asking questions, and we'll get them answered.
So we're going to start here as a reminder that this PPP loan is a loan. That's what those of you who have been approved and have received funding, you have a loan on the books. It's a 2-year loan, 1% interest. As we pointed out earlier, you do the right things, you can apply for forgiveness. Now that loan, you don't have to make a payment on for at least 6 months until after the date of disbursement, the day that the money hits your bank account. That date of disbursement is very important. I hope everyone has marked that on their calendars. The day that the money hits your bank account, that is a very important date. You need to know it for multiple reasons. This is one of them. 6 months, 6 calendar months from that date will be the first payment of the loan if you need to repay the loan. But again, if you follow those correct procedures, you spend the money on the approved expenses in the right proportions, payroll, rent, interest, and utilities in the right amounts, 75% of it needs to be on payroll to achieve full forgiveness. You spend the right time period, that 8 weeks, not just 8 weeks, 56 days, specifically mentioned, from the date of disbursement, that date the money hits your bank account, the one that I just said, make sure you've circled that on your calendars. Forgiveness is not all or nothing. this is great. You know, we were concerned with the reading of the guidance that was coming out related to the loans that perhaps if someone didn't hit that 75% payroll threshold, they would not be able to achieve any forgiveness. But it's now clear that that concern has been alleviated. So in other words, if you hit 70% of your funds were on payroll, you would not receive full forgiveness, but you would get forgiveness for any eligible payroll expenses that you did spend. So that was some good news that we got with this latest information from SBA. And then again, anything not forgiven, it's a 2-year term at 1% interest. So worst case scenario, if you can't get it all spent on the right categories of spending in the right amount of time, you'll have a loan that you'll have 2 years to pay back.
The timing is really important on this. The clock starts the day the funds hit your bank account. So mark your calendar with that. The next 8 weeks, as Keith said, 56 days that start on that day is what's called your covered period. And that is the period in which all the records are going to happen, and that's when you have to spend the money. Now, you need to complete those 8 weeks and actually spend the money before you can apply for forgiveness. So we're going to gather all the information along the way, but you can't actually complete your application until after this time period is over. You're not going to need to rush to do it on day 57. As you will learn along the way, it's going to take a little bit to gather the paperwork after the covered period ends, but we want to encourage you to address it earlier rather than later. While your first loan payment won't be due for 6 months after you get the funds, so you're going to have a lot of time in there, don't wait until the last week. I heard a statistic that said SBA processed 14 years worth of loans in the first round of PPP alone. So think what kind of a volume that means now for forgiveness applications. You don't want to put it in the last week and hope it gets processed and forgiven before the first payment is due. I don't think that would be a reasonable expectation. So let's just make sure that we are marking our calendars for 3 months out from the date we get the funds, and that would be a good time to apply for forgiveness.
So the basics of that covered period, that 56 days, that 8 weeks from the date of distribution of your funds, it's the amount of time that you have to spend your loan funds to qualify for forgiveness. Again, it started that day that you got your loan funds, 56 days out. If it started on a Friday, it ends on a Thursday. I've heard a lot of folks say, well, it's 2 months, and they look at it as, well, if I got it on a Monday, I can end on a Monday. Nope. 56 days, exactly 7 calendar weeks. So if you got your money on a Friday, 8 weeks ahead, that Thursday is your last day. And I know, that last statement, yikes, how do you handle payroll with this? A lot of our payroll periods don't run on exactly the same schedule as when you got your money. Well, SBA thought of this, and they've actually given us a nice tool to deal with that, which Erin will tell you about next.
Right. Now that is known as the alternative payroll covered period. So you have 8 weeks for all of these expenses. The one exception is payroll. If you choose, and if it would make your life easier, you can use the 8 weeks that start with the start of your first pay period after you got the funds. So if your pay period begins on Sunday and you got the money today, you could use this Sunday as the start of your 8 weeks for payroll only. In order to qualify for this, you must pay biweekly or more frequently. So weekly would also count in order to be eligible for that. If you choose to use this alternative period, you must use it for all the payroll calculations that now come further along with your application in calculating full-time equivalents, etc., unless it says covered period. If you use this alternative period, you must also continue to pay everybody on schedule, particularly that last pay period, because it would run outside of those 8 weeks. So those are just some things to keep in mind. If you want to use for administrative purposes this alternative period, you need to know there's a few other things you need to follow through with.
So what counts towards forgiveness? What costs? Payroll, the same amounts that were counted when you applied for your loan also count for forgiveness. The gross wages paid to U.S. resident employees, maximum of $15,385 per employee. What's magical about that number? Well, that's the equivalent of $100,000 or $100,000 compensation for a full year, proportionate to an 8-week period. If you will recall, the compensation to any individual over 100,000, that amount over 100,000 was excluded from qualifying for your loan amount. It also is excluded in counting for forgiveness amount. It also includes the employer share, the amount that your company pays towards healthcare benefits. So let's say you have a company where it's company plan where the employee puts in half, you put in half, only half of the cost is counted for forgiveness, just like it was for the loan amount. Same thing on retirement benefits. Your matches for retirement plans or your discretionary contributions or your mandatory contributions, those are counted. And then your share of state and local payroll taxes. Each state is different in how that is, but generally it's the state unemployment. And then, here in New Jersey, we have a couple of other small employer contributions to payroll taxes. Every state is different again, so that's going to be very state specific. And then remember, the employer share of Social Security and Medicare don't count, neither does FTES or workman's comp. There was a lot of confusion about that early on in the process because the guidance was unclear. It's very clear now. Only the employer share of state and local payroll taxes count. What your company pays for other payroll taxes is not counted. Those federal taxes. It does not include withholding. We've seen some confusion on that. That's already included in the gross wages of the employee, so you don't get to count it twice. Paid and incurred means that this is language that's used, and we're going to explain how that's going to be applied, but the short version is there's no prepayments. So if you think that perhaps maybe we can get a little bit extra in our 8 weeks by paying ahead on our health insurance a few extra months, nope, they're not going to allow that. Has to be either paid or the expense has to incurred during the 8-week time period or that alternate covered period in the that Erin just talked about with regard to payroll expenses.
Now, what does paid and incurred mean? If you want to geek out with us, that's the difference between cash accounting and accrual accounting. So if you're following along in the vernacular, paid just means the day you wrote the paychecks, or if you have automatic payments, direct deposit the day the ACH is originated. So those amounts count if they're within your covered period or the alternative period if you choose that. Payroll is incurred, meaning the employees earn it on the day that they work and earn their pay for that particular day. So both of those count right now. The incurred but not paid means if your covered period ends partway through your pay period, you'll get to allocate the pay that was earned on those last couple of days up to the end of your covered period, as long as you pay that on the next regularly scheduled payroll date. You do have to do the math to allocate that. Then the question that everybody wants to know is, what if it was paid but not incurred, meaning I got the money today and tomorrow is the payday. So those hours were earned before the covered period started, but I'm paying that paycheck tomorrow. Right now, that looks acceptable, but further guidance may change that interpretation. So pay attention to the rules as they change, and also make sure you're managing forward, not just counting on things that have happened in the past.
So what's eligible for those of you who are considered self-employed? And self-employed has a unique definition in with regard to the PPP program. There's been quite a bit of confusion on this, and it's because it has been admittedly confusing how it's been administered. But after the dust has settled, where SBA has landed in terms of defining self-employment, essentially your sole proprietors or your partnerships. LLCs, if you are taxed as a sole proprietorship, i.e. it's a single member LLC and one person is, you file on a 1040 and there's a Schedule F or a Schedule C that represents your business activity, that is, you're considered self-employed in that regard. And then if you're an LLC that's taxed as a partnership, you get a Schedule K1. You get a Schedule K1 that is attached to a Form 1065 partnership tax return, those two types of entities, really three, if you count the LLCs in there, they would be self-employed. Now, your LLCs, I'll caution you, some of you are taxed as a corporation. For those who are corporations, you are not considered self-employed for this particular carve-out here. So your Schedule F or Schedule C, your sole proprietors, you are a sole proprietorship, you have one owner. And even if that owner is married, we've had some confusion over this. If you're married and there's a sole proprietorship, one of the married partners is considered the owner. Sole proprietorship can never have more than one owner. Anything with more than one owner has to be either a partnership or a corporation in the tax world. So that usually the name of the owner is at the top of that Schedule F or Schedule C. And it's the profit. If your business did not show a profit in 2019, and it's the 2019 tax return, not the 2018, the 2019 tax return, even if you haven't filed yet, you were permitted to fill it out and use it for your application. And you had to have submitted that tax return with your application. You had to have used that income as part of your application for the loan in order to use it for forgiveness. This is very important. So that profit, if you did not have a profit from your Schedule F or Schedule C, sorry, no self-employment income. Same thing on your partnerships. Box 14A of your Schedule K1, very specific place to look. In the lower right-hand side of that Schedule K1. Box 14A tells you what each partner earned in terms of earnings from self-employment. That's the amount that you could have counted for your loan. And if you did count it for your loan, you can also count it as an allocated portion of that for your forgiveness piece. Your corporations, I'll come back to that. Your owner's pay was included as salaries, wages. That's that employee, you are an employee of the corporation. There's no additional self-employment incomes from distributions allowed. So it's just your owner's compensation, your officer salary, et cetera, that was permitted in terms of both for loan purposes and for forgiveness. So for those sole props, the partners, the amount that you are eligible to claim for forgiveness, it's an automatic calculation. It's that amount, that Schedule F profit, that Schedule C profit, or your partner earnings from self-employment from box 14A to K1. You multiply that number by 8, divide by 52, and that's the amount that you can put on the forgiveness form for your earnings from self-employment. It's automatic. It's based on your 2019, has nothing to do with what your business has earned so far in 2020. You're limited to 15,385. That's the equivalent, again, of $100,000 of compensation for the year. That's the limit, the maximum that each owner or partner can claim from earnings from self-employment. And that you can only claim that amount if you had $100,000 or more profit per partner or per owner in the case of sole proprietors. It's the actual amount that you claim.
Now, if owners did apply for earnings to protect their own paycheck, and that would be owner employees and corporations, right? That was part of payroll, as Keith just described. If you are a sole proprietor or a partner, you are going to have to report your earnings separately. It will count towards the payroll costs, the 75% that we're aiming for, but your hours will not count towards the full-time equivalent calculation. That is okay. They did not ask for that earlier on, so you're not losing out on anything, but we just want you to know that we're not going to be part of the FTE calculation. If you filed a draft return when you made your PPP application, just keep in mind the one that you file with the IRS matches your draft, because we don't want to end up answering any questions about why your taxes are now different than what you applied for with the PPP loan. We realize that with the tax deadlines changing, with people filing extensions because there's so much else going on, that could happen. So just a reminder, have that conversation with your tax accountant so you make sure that everything is in line.
So we've gotten this question quite a bit. What about if we are using guest workers, H-2As, H-2Bs, J-1s, etc.? The SBA guidance, although they did address residency in a little more detail, they did not mention temporary workers. They did not mention these programs specifically. The guidance that they did provide late in April uses the IRS residency test that's used to determine in which state you pay income taxes, not which country. So again, it's still, unfortunately, still a bit confusing and unclear as to what this means with regard to any guest workers. So since there's no official word on this, we really are not thinking that many banks are going to expand that acceptable list. So our advice is plan your spending and forgiveness application without these guest worker wages included. We think that's the safe bet with regard to this particular issue, since there is not any clear guidance, and they've certainly had opportunity to give us clear guidance about these specific programs.
All right, so that about sums up payroll in terms of what counts. Now we'll move on to the non-payroll expenses. There are only those three that you could use PPP funds for, and those need to be paid now during your covered period. You don't get to use the alternative period for these other expenses. Right? They can be paid or incurred and then paid on or before the next regular billing date. So if you are running the electric meter and then the bill comes after the fact and you pay it on time, the part that was incurred during your covered period will count. You can do the same with interest, but you are going to have to allocate for what part was incurred during your covered period. And then, of course, document not only the calculation for what was incurred, but that it was paid on schedule. Just a reminder, as we go through all of these, the obligations for utilities, rent, and interest must have been in place before February 15th, 2020, and they must be supported by written documentation that was already in place. No prepayments are allowed, okay? So if you typically don't make payments on rent until later in the year, with very little exception, you're not going to be able to count that. We also highly recommend you apply the New York Times test or Boston Globe test, whichever your major metropolitan newspaper is. If you would be embarrassed to read about it on the front page, don't do it, right? Think about the difference between, oh, workers kept paid at local farm through COVID-19 with PPP funds, right? Good job, owner. But if it turned around and said, oh, owner gave family members raises during COVID-19 with government money, that's going to portray a much different story. So just keep that in mind as you're going through what expenses you want to claim. And really, it's the Paycheck Protection Program. So focus on payroll, payroll, payroll for your employees, and you'll be in really good shape.
So let's talk about these, the mortgage interest obligations. What's covered under the Paycheck Protection Program in terms of eligible expense for forgiveness? It's business mortgage interest. This is real important. Interest only, none of your principal. So you have to look at specifically that interest portion of your payment. Payments during that covered period only. You can't use the alternate payroll period for this because that applies only to payroll expenses. So to cash payments, the bills that you've received and the bills that you have paid during the covered period that were incurred prior to, you can still pay those and they'll be counted, or incurred and paid as scheduled. So let's say your covered period ends on the 25th of a month and your interest is due the 1st of the next month. You could prorate the amount that was incurred during that covered period, that last 25 days of that month. You can prorate that bill and apply that amount towards your forgiveness. Now the second main bullet here, on real or personal property. This answered a big question that we had, because there was conflicting language in the bill and in some of the SBA guidance on whether it would only apply to real estate mortgages or whether other business loans would count. And basically, if the loans have collateral of real or personal property, for those of you that are not familiar with what personal property is, that's machinery, equipment, inventory, cattle, that sort of inventory, or sort of property, your buildings, your assets that are, not dirt essentially, but owned by the business. Those, if you have a loan that's collateralized by any of that property, it will count. So vehicle loans, tractor loans, probably operating loans, because most of the operating loans that I've seen, both through Farm Credit and other banks, have some form of collateral behind that. If you have that collateral, sure. Now, credit cards, very few, if any, credit cards have any collateral behind them. In fact, I don't know of any credit cards that are collateralized. So your credit card interest, I don't think so. But your operating loans, pretty good chance that the interest on those will count. Key points with related to this, and it's going to be a theme that you'll see through all of these expenses. You must have had that loan in place on or before February 15th of this year. And you need written documentation, thinking back to some of our, maybe some family debt. Do you have a written documentation for that? Do you have a loan schedule for that? And again, no prepayments. You can't pay ahead on your interest on your scheduled interest payments. Only either paid or incurred during the cover period.
Moving on to rent. For businesses, you can claim the rent or lease payments that are obligated in the name of the business that received the PPP funds. Both real and personal property count again, so vehicle leases, machinery leases can be counted here. Again, they have to be paid or incurred during your covered period, no alternative period here, and paid as scheduled. So even if the bill comes or is due after the covered period ends, as long as part of it was incurred during the covered period, you're good to go. And here's the rent exception that I meant. If you pay annual rent in November, you do technically incur 2/12 of it, 2 months during your covered period. So you could pay that and have that counted. Now you would need to pay it and have the documentation that it was paid before you apply for forgiveness. So just keep that in mind. Again, obligations must have been in place with written documentation before February 15th, 2020. So all those times you thought your farm credit consultant was just being a pain in the neck and a stickler, well, if you followed their advice, you'd be in really good shape for that right now. If you just have a handshake lease, though, not going to count. Again, no prepayments. So that incurrence of rent, right, what has been incurred during this period would count, but not the rent for the rest of the year. And again, keep that newspaper test in mind, especially if this is a rental to or from a related party, especially yourself. And don't get creative with the payment schedules, because if you haven't been paying rent regularly, especially with a related party in previous years, it would be hard to say that there's a legitimate reason for the change now, especially if it was just to take advantage of PPP eligible costs. Okay? So keep to what normal operating procedures are, and you'll be in good shape.
So our third category of non-payroll expenses that are eligible under the PPP program is your utilities. And again, we've had a lot of questions on what is a utility. So we do have some more detail on that. It's these several categories here. Those utility payments towards the distribution of electricity, gas, and we believe this is natural gas, propane for purposes of heating or cooking, in case if you were operating a commercial kitchen or something within your business, water, transportation, telephone, or internet access. Any of these categories are includable as utility payments. Again, it's paid during the covered period, not your alternative covered period, or incurred during that period and paid on or before the next regular billing date. So again, the example, if you got the money, if your covered period ends on the 25th of the month and you normally get a bill on the 30th of the month, well, that you figure out if it was a 30-day month in that particular period, the last 5 days gets prorated off of that, and the rest of it would count towards that. But you must pay the bill on time, or even you paid a bill early, that's fine, but you must have paid by when the bill was due for those bills that come after the end of your covered period. Again, the services must have been in place before February 15th. So if you just had a natural gas hookup on March 1st, I'm sorry, that's not going to count. Had to have had this service in place on February 15th or prior, and have some written documentation. I don't think that's going to be as hard with these sorts of expenses as some of the others, but you still need documentation to show that you paid the bill. Now, a question we're going to get, and we've already gotten, what about diesel for my tractors? Is that transportation? Not really sure. But there's no prepayments. So what it counts as a prepayment. So let's say we fill our tank for our vehicles, or we fill up our propane tanks for our greenhouse fuel. Well, one could argue that the prices are lower than they've ever been, or they have been for quite some time, so it's a good business decision. So yeah, you would have done it anyway. I think that's acceptable. So it's still a little bit of gray area there, but use good judgment with it, and I think you'll be okay.
Just to recap, mortgage, interest, rent, and utilities are the three things that you can use your PPP funds for other than payroll. Again, it is the Paycheck Protection Program. So all those questions about, can I buy inventory? Can I buy feed? Can I buy supplies? Can I use it for repairs? No, it's only mortgage, interest, rent, and utilities aside from payroll costs. These costs only count during the covered period. You cannot use the alternative period for anything other than payroll. You must pay for these expenses or incur them during the covered period and still pay them on schedule. They have to have been in place prior to all of the COVID-19 shutdowns, and the date SBA uses for that is February 15th. You have to have written arrangements and documentation that were also in place before February 15th. And in no case will any of these be eligible for more than 25% of forgiveness in total.
So how do we actually calculate this forgivable amount? Basically 3 steps. First, we figure out what our eligible costs are, going through all the previous slides where we went through what are those eligible costs, paid or incurred during the covered period or alternate covered period. We adjust for reductions, which we are going to talk about. There's a Schedule A on the forgiveness worksheet, which we will describe what calculations will be there for wage or salary reductions, for reductions in full-time equivalent of employees. If you happen to have gotten an EIDL loan, which there's been quite a bit of press about this over the last few weeks, that in the second round of funding, agricultural businesses have become eligible for the EIDL. So some of you may have gotten that, and some who may have been eligible prior to that, who had a non-agricultural business. If you got an advance for that, it was up to $2,000, SBA will automatically reduce your forgivable amount by the amount of the advance. Essentially, so you don't have to double dip, or you can't double dip in that. And then the overall amount spent on eligible payroll costs. And then step 3, we complete the form. And that overall amount, that refers to whether you had 75% of at least 75% spent on payroll. If you did not hit 75%, you will have a reduction in the amount that you have forgiven based on the difference between 75% and what percentage you actually hit. Complete the form with all the math, then you submit that form.
Now, there is going to be a fair amount of math, and you're going to have to go through it regardless of whether or not you pay, just to prove that you didn't. And it'll be worth it again, remember, because you're applying to get a pretty good size loan forgiven. So for each employee who either earned less than $100,000 last year, looked at on each pay period, or who did not work for you in 2019, you're going to need to figure their average wage or salary rate during these 5 different time periods. We know that's a lot of math, and there are going to be some tools out there, I'm sure, to help us through that. But the reason for this is if you earned as an employee less than $19.23 a week on average in every pay period during 2019, those are the ones that are especially protected under the Paycheck Protection Program. So you'll need to demonstrate as the employer that these folks were taken care of, that their pay was not cut especially during the covered period. And if it was cut earlier because of economic conditions in your business, that you use the PPP money to restore their pay rate.
So how does this calculation work? For each employee that we tracked on that form, those that made under 100,000 or the new hires, if pay is reduced by 25% or more when you compare the average pay for, now you've got some information here, January 1st to March 31st to your covered period or alternate covered period. and it was not reinstated by June 30th, your forgiveness will be reduced by a comparable percentage. So, go kind of think that through. If someone was making $15 an hour or $20 an hour, January 1st to March 31st, you drop their pay by 25% or more, and that's what they were earning during that covered period, and you didn't bump them back up to that $15, $20 an hour, whatever it was, by June 30, you're going to get a reduction, and it's going to be comparable to the amount that it was below 25%. So bottom line, the Paycheck Protection Program, use the Paycheck Protection Program money to keep your employees paid.
Now, if you did reduce pay, there is a safe harbor, meaning you can get back into good graces if you have either one, maintained the pay levels in place since January 1st. You don't need to worry about forgiveness reduction because you've done what they have asked you to do. Or if you restore the level of which you were paying prior to March 31st by June 30th. So bring people back at the pay levels that you were paying them before all of this started. Now, there is a caution here. The safe harbor does not apply if you happen to give raises between February 15th and April 26th, and then you cut pay after you got the PPP funds. The only way you can get around forgiveness reduction is giving back the raises and maintaining the pay at the level that folks were at before April 26th. So again, if we're funneling all the PPP money into Paycheck and at the pay rate that were described before all of this started, we should be in good shape. So think about using your PPP money, if you haven't already, to reinstate whatever was going on before all this started.
So that covered the potential reduction in your PPP forgiveness based on wage or salary compensation levels. Now we're going to go into this full-time equivalence. And this has been, we've had a lot of questions on this. And I'll start off first, the date that you put on the form, the date that you put on that form when you applied actually has nothing to do with this. We were concerned or confused, quite frankly, on what relation that would have. Turns out it doesn't have any relation. So here we go, all new information. So first, we choose our reference period. You either use February 15th to June 30th of last year, this time period that where COVID-19 is really affecting us in 2020. Well, let's look at what it looked like in the same time period in the prior year. Or you look at January 1st to February 29th of this year. And then if you applied for your loan as a seasonal employer, that's what you put on the form when you applied. And you can pick either of those first two dates ranges or the consecutive 12-week period between May 1st and September 15th that you used as to qualify as a seasonal employer. Our hint, choose the one that has the lowest FTEs, because that's going to give you the best chance of avoiding a reduction. This is the reference period that you're comparing your covered period to. Then you calculate the full-time equivalence for that chosen reference period and your covered period, or if you use the alternate covered period for payroll, you use the full-time equivalence during that date range. And Erin's going to show you how we calculate those full-time equivalents.
And the good news is, if you've done any benchmarking with us, you'll be familiar with this process, right? You list each employee, you'll list the hours they work for the time period that you're looking at, and then divide by 40, because the FBA standard for this program is 40 hours a week as a full-time equivalent. Now, because it's a government program and there are nuances, they are asking you to round to the nearest tenth of an hour. Once you have that number, that is your FTE, full-time equivalent count. Unfortunately, overtime does not increase the FTE count. Each employee can count for a maximum of one full-time equivalent. But there's some good news that comes along with that. So you don't need to worry about what you put on your application with regards to this. And Keith will give you that good news next.
So we do have a safe harbor for the FTE reduction. So if, and these are the ifs, if you reduce your FTEs between February 15th and April 26th, and, that's an and, restored the FTEs to what you had on February 15th, that pay period that was in February 15th, that included February 15th, by June 30th, then your forgiveness will not be reduced to FTE. So this is something that you can do. We said a lot of this, you'll do the form and you'll complete a lot of the math when you're done. This is something you should be tracking and be prepared to act before June 30th. So if you know that you've gone down in staff time, staff level, you've got till June 30th to get it up to the right level, and then you'll be fine. If you don't meet that safe harbor, the reduction is proportional based on the decrease in FTEs. Essentially, it becomes a fraction that you apply, and that proportionally decreases your forgiveness amount. And again, not related to that employee count on your application. That's something we were concerned about because there was such fuzzy guidance on that in the beginning. Some folks put number of W-2s. Well, that was the best guide. In fact, we gave that advice early on. Well, it was wrong, but we didn't have good information. But it's not going to come back to hurt us, which is a good news for us and for you.
So what about if it was the employee's idea to cut FTEs, not yours? This can be solved with documentation on your part. So if you made a good faith written offer to rehire someone that you had laid off and they decide they don't want to come back, document that. If you fired someone for cause, as would happen in the normal course of business, or someone voluntarily resigned, that's okay, document that. If someone said, you know what, I don't want to come back or I don't want to work as many hours, get that in writing as well. That does not count against you. And we are starting to see unemployment claims that are being denied because you voluntarily left your job. You were not authorized or not ordered by a healthcare professional, so it doesn't count for unemployment. It was your choice as the employee. So if you have reductions in these cases in your full-time equivalents, it won't reduce your forgiveness. You do not need to even report them if you were able to fill these positions with someone else. But you do need to document all this in writing. So keep really good records of these things.
What is our forgiveness amount? So again, maximum forgiveness considers payroll costs first. That's 75% threshold. If you've been paying any attention to us at all, you've heard that 75% number many times. So you calculate it this way. This is how SBA has decided we calculate 75%. You take your eligible payroll costs, the amount that you spent on payroll, you divide by 0.75 or 75%. That is the maximum forgivable amount that you will have. So if you hit 75% or more of your loan, then you will not have any reduction. If that number, that eligible payroll cost is less than 75%, that will result in a reduction of your maximum forgiveness. The more you spend on payroll, the more of the other expenses you can potentially have forgiven. Again, spending extra on interest, rent, and utilities does not get you more forgiveness. You are capped at the maximum you can get is 25% for those three categories. If you don't spend 75% on the amount of payroll, you're not going to get the full 25% of 9 payroll costs forgiven either.
All right, so we've always heard if it didn't get written down, it didn't happen. So this is the documentation part of applying for forgiveness. Here, it's going to need to be more than your own internal records. In a lot of cases, you were able to supply either canceled checks or QuickBooks reports or other general ledger accounting in order to apply. However, this is going to have a more significant burden of proof because, hey, the stakes are a little bit higher here with actual forgiveness. You're going to need to provide documentation that a third party acknowledged or processed, meaning invoices and receipts, canceled checks, account statements, and there are specific requirements for each type of expense here. So right now we're recommending you start a PPP forgiveness file, and as the appropriate documents come across your desk or through your email, stick them in there so you have a lot less of a project to gather in 57 days. One thing you want to keep in mind is that file needs to be kept around for 6 years. And then as Keith said, have a bonfire. But until then, you need to keep that information in case FBA wants to look at it.
So, as Erin said, each category of expense has its own unique spin on documentation required. Here's what you need to keep for your payroll. So, You have bank account statements or third-party payroll service provider reports. So if you are using a third-party payroll provider such as Paycheck, such as Farm Credit East, such as ADP, the reports that they generate, those providers generate, will suffice as documentation, or your bank statements that show payroll being paid. Tax forms, such as your 941s, your 943s, I'm going to talk about those 943s here in a minute, or the equivalent payroll provider reports. Again, those of you using a third-party payroll provider, that's going to give you the easiest path to getting documentation. But it must cover, those reports have to cover period, and in some cases you may have different tax forms overlapping if it's a quarterly change there. So the SBA guidance talks about 941. They're silent to 943. 943s are, of course, is for your farm labor. Those are reported annually, not quarterly. As Erin said early on in this presentation, it took SBA a while to get caught up with the agricultural tax forms on the front end with loan. We expect they will get caught up on some of this documentation for forgiveness, so stay tuned. We'll share that information once we get it. And then this is a big part, and, see, that's an and, not an or. Your state quarterly business, individual wage reporting, and unemployment insurance tax filings reported. So whatever state you're in, your state tax returns will need to be included as well. That documents your share of the tax return, of the taxes paid. And then payment receipts, canceled checks, or account statements for your employer, the company share of contributions to health insurance and retirement plans. That will also cover those shares as well. But the account, again, the account statements, if you get a statement from your health insurance provider, that negates the need for receipts and canceled checks. But if you're not getting a statement, you have to use those receipts and canceled checks. Your own records, your printout from the QuickBooks or Centerpoint or whatever software you're using, that's not going to suffice.
How about those FTEs? Remember all that calculation you were doing earlier on? You're going to keep a chart of that or a spreadsheet. You need to calculate average number between February 15th and June 30th of last year, or you can choose this year, January 1st through February 29th. Or if and only if you applied and were approved as a seasonal employer, you can pick 12 consecutive weeks between May 1st and September 15th of last year. That is going to be the base period against which you are going to then compare for forgiveness in your covered period. So that's the documentation that you need to provide. And that's going to come from payroll records. So again, payroll tax filings that are reported or that you will file, because the filing period doesn't always line up with your covered period, and your state quarterly reports that get filed are also going to be required. If you're a 943 filer, which you wouldn't do until after the end of December, that is going to pose a little bit of a conundrum. So stay tuned. It took a little while for SBA to recognize ag forms, but we did persist. So expect that more guidance will come out on that.
So again, if I file a 943 and I'm not subject to unemployment, what do? Just to reiterate, the SBA doesn't work with farmers. That's what Farm Service Agency and the other USDA agencies do. They've got to learn what differences we have. It's going to pay off. Persistence will pay off. Be patient. If you're one that needs to do something, maybe send an email to a regional SBA office. We found that can get things moving sometimes. And certainly coming from a borrower, that's going to carry some weight.
So for payroll records, you're going to need your employee list, as we said before, with the calculations for income as well as hours. And it's going to be everyone who is on your payroll during your covered period or alternative covered period, whichever you've chosen, who reside in the U.S. You're going to split them into two tables. The ones whose cash compensation was less than $19.23 a week for every pay period in 2019, or the folks who are new to you in 2020. That'll be on one table. The second table will be employees who were over $19.23 in any week last year. And the reason that we want to keep specific track of those folks is they aren't subject to the wage reduction test. So if you paid bonuses late in 2019, we think this actually helps you because that may kick them over that threshold, and then you don't have to worry about how that payroll with a bonus compares to this time period without one. And finally, if there are more than one owner, if there is more than one owner in the business, they'll be reported on a separate table. And we'll get into that as we get later into the covered period and work on how do we actually fill out these forms.
So for each of those tables that Erin mentioned, you're going to keep the employee name, the employee identifier, which is the last 4 digits of their social security number. What was the cash compensation, the actual gross wages there that they were paid? What was their average FTEs during those different periods? And then the salary and hourly wage reduction for those that make it on the table 1 that may apply. If you ended up not having a wage reduction and not having an FTE reduction, there's not going to be any number there. It'll be a 0. So you compare your covered period or alternate covered period against January 1st to March 31st of this year, pre-COVID-19 period, and that will determine your reduction to forgiveness.
More documentation on rent or lease. Come up with that written lease agreement, dig it out of the files, be very glad you have it. Go give that farm credit consultant a thumbs up, and make sure that you have the canceled checks or receipts that go along with it. Or if you can get an account statement, you're going to need the time period from February 2020 to prove that it was in place before February 15th, and that needs to extend through your covered period plus 1 month, because again, we're going to have incurred expenses that may not have been paid within the covered period. Same thing's going to happen with mortgage interest. You'll need the lender amortization schedule and any receipts or canceled checks. That'll be more like private party loans, because a more formal lender will have an account statement for you. Again, that time period needs to be from February 2020 to establish that it was in place before the beginning date. And again, go through the covered period plus another month so that you can show those incurred and then timely paid expenses that fall outside the covered period.
So your utilities, you'll need copies of invoices from February to show that it was in place in February and during the covered period, and your receipts, canceled checks, or account statements that showed that you paid those expenses during the covered period or by the next account date. And so again, reminder, what counts as utilities: distribution of electricity, gas, water, transportation, telephone, or internet access. And some may ask, well, what about, I have all my account done online, it's automatically withdrawn from my account. You'll have to log into that account and get a printout of those statements. You can still get your statements. You can go on paperless. You just have to get some paper to show for your documentation.
Whew, that was a lot. So where do we even start? First, mark your calendars with these dates. Your covered period, so the day you got the funds and the next 8 weeks out. If you choose to use the alternative covered period for payroll, highlight that in a different colors so you know the time period that you're working with. Take that PPP funding date and add a month. That is a really good time to look at the mid-period position and see, how am I doing compared to my target? Mark again 7 weeks out from that PPP funding date. So you're going to review where you are against your plan in another 3 weeks. That'll make sure that you're in good shape as you wrap up the period and you can make any last adjustments necessary. And the other date to put on the calendar is 3 months out from your PPP funding date. You won't be able to apply for forgiveness on day 57 because you'll still need to collect some statements and accounts. But if you are on it for 3 months after you got the money, you'll be in good shape to apply for forgiveness. So those are just some targets we want you to have out there and keep in mind. Right now, you can start that documentation file and begin collecting documentation. And then mark your calendars for Wednesday mornings for the foreseeable future. As long as it's useful, we will be hosting office hours so you can bring your specific questions, and that is where we will work through them all. That way we can use the benefit of working together, because if you have the question, chances are someone else is going to have it as well. And you can find that schedule on farmcrediteast.com/webinar. So now back to Tom Cosgrove, who's going to wrap us up and handle the questions.
Great, thank you, Erin and Keith. Excellent presentation. And I will note for our participants, I see we are at 10 o'clock. Obviously, there's a lot of material to cover. We are going to stay on for about 10 or 15 minutes to try to get through some of the questions that have come in. But before we do that, I wanted to just point out, I mean, obviously, over the last couple months, a lot of activity relative to the PPP, and but I would note that our business consultants like Erin and Keith, and we have consultants across our organization's territory, they can help with other things too. Certainly with all that's going on with COVID-19, adjusting farm budgets, helping you think through operational adjustments, profitability consulting, other things like estate planning. So I would just say, keep in mind that our consultants are available for a range of activities, and obviously you can tell the expertise that these folks demonstrate. And listed at the bottom of this slide are the other services in addition to business consulting that we offer. So certainly reach out to your local Farm Credit Office to learn more about these services. And then just kind of a reminder, we mentioned this at the beginning, on farmcrediteast.com, we do have a dedicated resource hub to information related to COVID-19. And then there's also a tab under there for webinars where the recording for this will be found. That's also where you can go to register for the office hours that they just mentioned that we'll be holding probably weekly through June as we work through the forgiveness period. And then I will just make a plug on that webinars tab. We are going to have we're kicking off a economic outlook series next Wednesday, and then going to be following up with some other webinars relative to the impacts of COVID-19 on the U.S. agriculture. And then throughout June, we'll be having one on specific sectors within Northeast agriculture, like feed, grain, and dairy, animal protein, meaning like beef, livestock. We'll also be looking at fruits and vegetables, and some of the other sectors. So that's also be coming, and that information is available at Knowledge Exchange /webinars. So now why don't I get to some questions here? We've had a number come in. I'm gonna say right now that I don't think we're gonna be able to get to all of them, folks. These will serve though as ones that we don't get to. We'll try to either follow up individually, or we'll put them together in frequently asked questions that we can then post. So here's a question relative to I guess a payroll-related expense. Someone asked if they do a one-time per year contribution to an employee's 401k. How would that get handled?
When do you normally pay that expense is the first question that comes to mind. So I would equate that.
And I'm assuming, Keith, that the presumption there is that it's probably not during the covered period.
Yeah, May during the end of the year. So, this is one of the areas that I don't think there's real clear guidance on, but essentially that's an expense that theoretically was incurred during the amount. Let's go back to Erin's example of rent. So you normally pay rent for the entire year in November for a farm that you rent. You could count 2/12 of that expense, and you need to pay the amount by the normal due date. Now, employer contributions are somewhat discretionary in the timing of it at times. So you need to determine what that due date is and make sure it's paid on time. You can't count an entire year's worth of retirement contributions for that 8-week period, but certainly you could count a prorated amount. You may need to adjust the timing of when you pay that. And I'll let Erin weigh in if she has any additional thoughts on that question.
I would just think you'd need to be able to document the incurred portion that was paid before you could apply for forgiveness. So just keep that in mind as well.
Okay. This gets to partners, well, I guess sole proprietor partnerships. As a partner, do I need to subtract box 12 from 14A to get net self-employment income?
Oh, good question. Someone knows their forms. No, 14A should be all of the self-employment income wrapped up in there, because you'll have your ordinary business income, but that you'll also have implications for Section 179. And if you have any depreciation recapture, that all should be molded in there and then compiled on box 14A. So that is the guidance SBA specifically gave us. That's what counts for partners.
Okay. Someone asked that when they applied, and the guidance may have changed during the application period. They talked about they asked about payments to contractors that they did include in the application, but didn't see where those could be applied for forgiveness. What's the guidance on that?
Yeah, the guidance that came out midstream was very clear that payments to independent contractors, those 1099s, cannot be counted as payroll expense. And the reasoning giving was that an independent contractor has the ability to apply for their own PPP loan on their earnings. So that was to avoid the problem that could be generated by two different businesses applying on essentially the same qualifying fund. So it's the SBA is very clear that a business who paid an independent contractor via a 1099, those expenditures are not countable towards your forgiveness, or technically even towards your loan amount, even though we know some loans may have gotten approved using those payments earlier in the process.
Okay. So someone had a question relative to the FTE test, asking why corporate owners don't count towards the FTE even if they get a paycheck.
That shouldn't have changed, right? You were already in last year, so it doesn't really matter because you're still in for this year. And if you only count as one FTE, right, it's kind of a wash. But the short answer really is that's the way SBA designed the form.
So the main thing is that if they're not counted as an FTE, they weren't counted in the base period, and they're not being counted now, so it doesn't count against you relative to the FTE reduction.
So
they would cancel each other out regardless.
And the application asks for a head count that is independent of this FTE calculation now, and it's really just administrative of where you're reporting it on the form, but we're calling it to your attention so that that's not a surprise later.
Okay. So someone asked relative to sole proprietor pay, is that considered part of the 75% needed for forgiveness?
Yes.
Okay.
Yes. Simple answer.
Great. Couple here in sort of the utilities thing, just a couple clarifications. Someone asked, you listed telephone, they asked about cell phones. Are those deductible or?
That's the only telephone I have, so yes, absolutely.
Okay.
And I imagine if anyone still has a pager, that would count too.
Okay, fair enough. Someone asked in sort of the fuel category about a propane tank. The question specifically was, basically that they fill 7 times a year, but I think the implication here is that maybe not during the covered period. So how would that be treated in terms of documenting the expense?
So yeah, I think that's a judgment call on the case of the individual borrower. And again, the advice I've given folks all along on forgiveness is payroll, payroll, payroll. And then once you run out of every possible payroll expense that you could have paid, that's when we start going to some of these other expenses. And so let that filling a propane tank outside of your normal pattern be one of the last expenses that you claim. I'm not saying that it wouldn't be counted. I'm saying that if they would get into a level of scrutiny that I'm not sure they will, but if there was a question raised as whether the qualifications were met, and remember, you got to hold these things for 6 years, and SBA says we have the right to ask for them at any time of 6 years. So if they would tend to review that, make sure that, we've spent as much on payroll as we possibly could, and that the least amount of forgiveness is based on something that's an example of. I personally don't think it'll be an issue for you, but it is, it's outside your normal spending patterns. A question could be raised as whether, it was a normal expenditure for you. But let's go back to also consider the fact that, fuel prices are low right now. So it would be a smart business decision if you had money to pay for heating fuel now. It's a good time to fill your tanks because it's cheap compared to normal.
Yep. Okay. I got a few questions here, and I think we'll probably take this as kind of the last ones we'll cover. They kind of fall in the form of basically the year-over-year FTE test and sort of pay rate test. So a couple came in regards to, whether if you have seasonal employees, but then they may not be the same employees year over year, and I think that's relative to FTEs. Is that permissible?
Right, it's all about jobs. So again, if you're going to look at the base period for FTEs, maybe you do the math on all of them. That gives you the opportunity to figure out where it was lowest. Because remember, it's protecting paychecks and jobs. So if your base period is lower than your covered period, you should be in good shape. And we realize there's a lot of different seasonality within agriculture as the year goes on, but you do have a little bit of flexibility if you're willing to do the math.
And then someone asked, and this is relative, I think, the wage test. Someone left, but they were replaced. They were replaced by someone. In a sense, do the wages of the new employee count?
Yes.
Yes. Yeah. Any new hires for this year count?
Yeah. There's kind of a general comment about that finding employees right now may be difficult. So, but I think you've kind of covered that relative to, in a sense, the offers of employment or people who have left voluntarily, in terms of documenting that you did attempt to retire people to get back to your previous year's level. Is that a fair assessment?
That's right. Yeah. I mean, that's absolutely right. And and again, if you're comparing yourself to yourself. So it's not as if you have to employ more employees than you ever employed. They're asking you to employ the same number of full-time equivalent employees as you did in January and February, or as last year, or as a seasonal kind of, there's different ranges. And as I looked at that, and it is somewhat consistent with the way the law was written on that FTE calculation. I've thought all along that many of our agricultural businesses, with the opportunity to compare summertime, late spring and early summertime number of employees to January and February, gave us a great opportunity to not have an issue, because for many of our farm businesses, January and February is probably the lowest period of employment. Now, I know there are some industries that's an exception for, but many of our industries have a higher employment rate during the spring and summer than they do in the dead of winter. So keep that in mind as you're wrestling with how you're going to qualify.
Okay. Last one here on kind of the pay rate issue is as you're looking at that year over year, is it sort of the employee's base rate, or is it their sort of actual rate, where you would potentially bring in overtime and bonuses?
The actual cash wage rate. So what they're actually been paid during that time.
Okay.
So yes, factor in the other.
The year-over-year comparison, basically. You mean?
Well, for the wage reduction, it's not a year-over-year. That's comparing to those other, those 5 different reference periods, and they all started in January. So we're not too worried about what they did last year with that. It's more what they did.
Gotcha.
The spending pattern, basically, if even though it looks complicated, if you just break it down to what were they making before COVID-19 in 2020, what was their wage rate starting January 1st, what were they making during your covered period, if they were making more or equal to during your covered period than they were in pre-COVID-19 impact, no issue. If you saw a reduction due to COVID-19, if you cut people's pay as a way to cope with COVID-19, well, then you've got till June 30 to bring them back up. You had that weird carve out that, okay, if you gave them a raise after February 15th and then cut their pay, well, then you got an issue. I don't know many people that did that. Maybe there are a few, but hopefully it's not that big of an issue for many.
Right. Okay, but the bottom line is relative to the wages, it's the actual wages from the reference period. Okay.
Yep.
Okay. All right. Well, folks, apologies for those we did not get to your questions at. We're at 10:15 now, so we're going to wrap up. Again, I want to thank Keith and Erin for their expertise and for digging into this for us. As noted at farmcrediteast.com/webinars, you could register for the Q&A session next Wednesday. And as I said, we're going to be posting the recording of this that will have a PDF of the slides for reference as well. So appreciate everyone attending today, and I hope everyone has a great rest of their day. Thank you.